Hi everyone, welcome to Foxon Media Digital. My name's Amy and today I'm joined by Gianina Thalmann, who's ESG Strategic Sales Manager at FE Fundinfo. So welcome Gianina, it's great to have you.
Thanks, Amy. Pleasure to be here.
Yeah, of course, you're our partner for the Summit for Asset Management ESG London, which is coming up on the 6th of November. So we wanted to catch up with you ahead of the event just to have a spotlight on yourself and find out a bit more about your company. So to start with, please could you give us a brief introduction and tell us a little bit about FE Fundinfo?
Of course. So, as a business, FE Fundinfo serves the global fund management industry, helping both asset managers and distributor operate more efficiently in their pursuit of, let's say, a frictionless global fund distribution. This obviously includes different types of services such as fund data management, document production, and distribution dissemination services. And all of that in one place via what we call the Fund Information Hub. One of the key challenges that we help asset managers address is their ability to comply and obviously also prepare for any changing ESG regulations, whether that be in the UK or cross-border in Europe or even abroad. So to that end, I'm the ESG Strategic Sales Manager at FE Fundinfo, where I lead the company's sales activities in ESG reporting, both on the regulatory side, looking at, for instance, SFDR, TCFD, but also on the marketing side, such as ESG fact sheets or more elaborate investor reportings.
That's fantastic. Thank you for that overview. And, as you've already mentioned, financial institutions operating in Europe no longer only have to face regulatory ESG reporting requirements in the European Union, but now also in the UK. So as a reporting provider, what are the main differences you see between UK's TCFD-based disclosure requirements and the EU's SFDR?
Well, there's a couple of key similarity and differences between the two disclosure requirements. Where I'd say they really share a common ground is the level at which disclosures are required. So both the SFDR and the UK's climate-related disclosure rules specify reporting requirements on both the individual fund level or the individual product level and also the entity level. And the means, however, by which those requirements have to be met differ quite significantly between the two. So firstly, and probably most obviously, the SFDR, so the EU defines fixed mandatory templates, which the industry has to use for the disclosure of their requirements. On the other hand, the UK's climate-related disclosure rules provide much more flexibility on how the required data and information can be presented and visualized. So there's no mandatory template that the industry must use. Secondly, also the calculation logic behind the metrics that are to be presented vary between the two. So the SFDR asks for basically a weighted average across an entire reporting period. On the other side, the UK's climate-related disclosure rules point to what we often call snapshot data. So a most recent available data within that particular reporting period. And then finally, the last one will be that the two requirements also differ in scope. So whilst the SFDR clearly defines different disclosures for different types of products, let's say Article 6, 8, or 9 products, the UK's climate-related disclosure rules apply to any fund, regardless of whether or not that fund may have sustainability intentionality.
Super helpful overview, and I know there'll be a lot of firms out there grappling with this, these key differences. So how ready is the market to comply with the UK's climate disclosure requirements, and what challenges do you currently perceive among your clients?
I'd say one of the main challenges that the market is faced with, and this is very relevant to the UK's climate disclosure, but also in broader terms relevant, I'd say, is the lack of expertise and understanding and know-how within the ESG space. So although ESG considerations and ESG investment practices are steadily increasing across the entire market, there is yet only a limited number of trained professionals with really deep expert knowledge in this area. As such, a lot of clients struggle to truly understand and interpret the data which they are now actually required to report on. In addition to that, I'd say the second challenge is that there's still what we call a timing gap in terms of data. Whilst the largest UK asset managers and asset owners have already had to disclose their first climate reports this summer, the respective disclosure requirements on the corporate side, so on the individual companies within those portfolios, have not yet entered into force. Both the ISSB's reporting standards, which are based on the TCFD recommendations, as well as the EU's Corporate Sustainability Reporting Directive, the CSRD, will only require sustainability disclosures on a corporate level to be published starting 2025. So there's obviously a certain gap in terms of the data between the time when the climate disclosures are required for investments and the time when the underlying corporates within those investments are asked to publish their credentials. So fortunately, however, data providers can already today offer quite a good data coverage nonetheless, thanks to their sophisticated modeling schemes to estimate emissions where they're actually not yet reported by companies, and then thereby, of course, analyze any future potential future scenarios.
Yeah, absolutely. And you touched on ISSB there, so let's chat about that, because in August, the Financial Stability Board announced that the TCFD will be disbanded and the ISSB will take over the monitoring of the progress of companies' climate-related disclosures from the TCFD. So do you expect the term TCFD to disappear in the market? What's the future of that?
Yes, that's correct. And I guess it's hard to say at this stage because the TCFD acronym is so commonly used and also recognized in the industry nowadays that it'll probably take quite a while until it disappears, at least completely. I would say probably the references to TCFD within official, let's say, regulatory documents would probably be replaced relatively fast. But on a wider scale, I guess the term TCFD will probably stick around in people's heads within the industry for quite a while, and then only slowly be phased out across the next month or even years to come.
Yeah, it makes a lot of sense. And like you say, it kind of encompasses a lot of the risks that people talk about colloquially. And we see that with the ESG term itself. So we'll just have to watch this space. But thanks so much for shedding a light on some of those very confusing issues that the firms are dealing with. And it's been fantastic to have you on the channel.
Thanks a lot.
And thanks everyone for watching. Don't forget to follow our YouTube channel for more content on challenges and opportunities in asset management, wealth management, and ESG. And don't forget to give this interview a thumbs up and hit the subscribe button.